Welcome back. In the last video, we talked about manipulation. How do you trade it? How do you know when you're in it? And we talked about how you need to be continually putting the story together. We also talked about the blending of the three phases and how it is vital to understand this and how you can benefit from it. In this video, we're going to be drilling down a little tighter. We're going to be talking about what to look for in terms of specific things to happen that will give us an edge in understanding which way the profit release is likely to go. Now, just like the card counter in Las Vegas, we are playing the odds. I'm looking to get onto that next winning run. In our case, the winning run is going to be the profit release of the market makers. Now, earlier we talked about the blending of the three phases: accumulation, manipulation, and profit release. In what I'm going to show you now will be giving you the edge. It will provide us with an insight into whether the market makers have been accumulating buy orders or sell orders. If we have knowledge that the market makers have been accumulating buy orders, then we can set a trade up for choosing a low risk entry into the market, expecting the market to go up. If we have knowledge that the market makers have been accumulating sell orders, we can then set ourselves up again for a low risk entry into the market, expecting the market to go down. The first tool we're going to use, or rather the first market makers showing of their hand, is going to be the stop take move. Now, a stop take move is where the market moves in the opposite direction to the direction that will ultimately play out in the profit release phase. This move in the opposite direction often takes place during a very short time period. It can occur in only a few seconds. But since that stop take leaves a footprint on the chart, you need not be worried that you'll miss it. But of course, you need to identify it. Now, rather than me trying to describe this verbally, I'll again turn to the whiteboard to illustrate this. Again, this is covered in much greater depth in my book and also in my training course. But I'm not holding anything back here, this in terms of telling you exactly what this is and what its purpose is. Let's have a look. Okay, so we're going to break this down pretty much in the same way as we did before, but this time we're going to be talking about the stop loss and using this as an indicator for entry, or to tell you where the market is highly likely to go in the future. For this case, we're going to change it around a little bit. We'll start off with our sideways market at the top here, say, and then we'll have a little bit of an up move, and then we'll now move, and then the market gets down here. Now, as the market starts to move down through here, what you'll see is that people will start to put in their sell orders down here, okay, going short, looking to trade the market down to short and to make dollars by the time they got down to the bottom here. Now, as this kicks off, what you'll find is that when you yourself, let's put this onto yourself here, that you yourself are actually thinking about, okay, now is a good time to put a stop in. So in other words, you've shorted the market, you've sold the market down through an area like this, and now you are starting to think, you know what, where is a safe place that I can move my stop to? And you're likely off to think about putting it above here. So you'll put a stop in right about there. Now, what's key here is to make a mental note of this, when you had that feeling, when you had that desire to put in that stop, where did it come from? It didn't magically appear out the air. It was given to you. That idea came up in your subconscious, then came to your conscious mind, that now is a good time to place that stop. Now, thinking about it, the thing that triggered that was this activity down through here. That's what triggered it. Without that occurring down here, you wouldn't have thought about putting that stop up there. So it's a key piece of information about how a chart, the shape of a chart, will manipulate you as a trader to do certain things, which is what this whole thing is about how you become manipulated by the market makers. Okay, then what you'll see here is sometimes you'll see a bit of a market like this, and then as the market moves up a little bit like this and then settles down into a down move. And this is a highly vulnerable point, because at this point down here, by the time the market gets down here, now traders who have got their stops here will move them down to here. And now this is just waiting for this process to happen, which you will have seen this many times yourself. The market then goes along, goes up like this, and then gets into its down move down through here. And what's actually happened is that now through here, as the market went back through up here, it took out the stops, this area here, which is what? It is accumulation. Think about this. So this is manipulation going up through here. And then through here, the stop take is actually accumulation. And so the whole thing happens again. So everything that we saw happen up here now happens over here. Look what happens back down as the market comes back down through here. Again, the same process goes through here. Now, let's talk, we've covered this bit. We've covered this in a previous whiteboard about what's going on here. And hopefully now you understand that everything that you see over here is just done here in Mini. And this is the blending of the accumulation, manipulation and profit release. But I said to you about this one, what you want to be looking for these stops. So when you have these urges to put the stop in like you did up here, make a mental note of that because other traders are doing exactly the same as you. They are being influenced by the shape of the chart as it comes down here. They are being influenced to put their stops into various positions. When they see the market break through down through this low point here, they are then influenced to then move their stop to this point here. So the whole thing is constructed in such a way that you are guided as to where you're to put your stops to. You're guided as to how to interact with the market maker's business model. By being consciously aware of this, where you thought about moving your stop to, in other words, this point here and then this point here, you will know that other traders are doing the same. By having that information in your mind or written down, whatever those prices, or marked up on your chart, when you see this market come up like this and do this, you can then relate it back to the thoughts and feelings that you had in this area here about moving your stop to. Suddenly now when the market breaks down here, now everything here makes sense, everything here makes sense, and now you can ride this market on down to get to your target that you want to get to. And target we will talk about in another video. Like I said, there is a great target that you can use from there, which is a very consistent measurement on there, which we'll talk about in a later video. But that is how you're using a stop loss. You are turning it around and you're using it as an indicator to confirm where these stops are, why they've been placed, how traders en masse have been, let us say, led to put these stops into positions where they become highly vulnerable for stop running, which again comes back to accumulation of more stock for then the market makers, in this case, to sell on down into the down move. Okay, so what you saw there on the whiteboard was the mechanics of the stop take and its purpose. Hopefully now you can see how the concept of the blending of phases starts to make sense. The process of a stop take is the harvesting of stops. This harvesting is in effect accumulating buy or sell orders depending on the direction of the stop taking. This is, of course, manipulation. The stop take has manipulated traders to enter the market taking wrong positions. Taking wrong positions means these positions will have to be closed, which results in more accumulation of the respective orders the market makers want, i.e. buy orders or sell orders. The markets are nothing more than a never-ending pursuit of profit for those that run and control the markets. You as a successful trader are going to be riding on their business activity. You don't have to invent or buy any trading strategy. You don't need to spend months looking at patterns on charts or learning technical analysis. All you need to do is have a thorough understanding and application of the market maker's business model. You know, I always get a bit excited around this time because when I'm teaching a trader, you know, and they start to get this, because it's around about now that they start to realise that this is not a complicated business. It's about this time when I get lovely feedback from the book and the training course about how the traders' fortunes have completely turned around and what difference it's made to them and their families. You know, this is why I spend the time working with traders. This is what motivates me. This is what sometimes keeps my boat on the driveway instead of discovering new fishing grounds. Okay, that bit wasn't true. If it's a good fishing day, I'll not be tapping on my keyboard or speaking into a camera. So what is incredibly rewarding, though, is when I discover that some traders I'm working with have been trading for years and have only just been treading water. It is a beautiful thing to hear about changes in people's lives. Okay, anyway, let's get on to when we talked about how to get out of a trade, and we'll cover that in the next video.